Good afternoon or good morning. Today we're going to be discussing navigating a soft workers' compensation market. We're going to give everybody just another minute to get logged in before we get started. In the meantime, we are welcoming any comments, feedback, or questions. Just please use the chat function and I'll be monitoring it during this presentation. And we will make sure that we address as much as we can. If we do have some questions that we can't get to during this 45-minute presentation, Justin and Morgan will be happy to address them after the presentation. So like I said, just give it one more minute and we'll get started. Here shortly. All right, let's get going. All right, my name is Laura Guthinger. I am the Associate Vice President and Managing Director of Burns & Wilcox South Carolina offices. Today, I am joined by our workers' comp experts, Justin Dorman. Hi, Justin. Justin is the National Product Manager for Burns & Wilcox Workers' Comp Division. He has over 15 years of experience and has been with Burns & Wilcox, specializing in workers' comp for over 8 years. Hi, Morgan. This is Morgan McCoy. Morgan is an underwriter in the Workers' Compensation Division for Burns & Wilcox. He joined Burns & Wilcox 4 years ago and has 15 years of experience in the insurance industry. I believe these two have always worked together in workers' comp. Our agenda today, just to kind of highlight what we're going to go over. Throughout this webinar, we are going to delve into the market conditions of workers' compensation. We're going to discuss some interesting claims examples. The gentlemen are going to provide a forward outlook on the workers' compensation market. We're going to go over some tips for brokers and specialty solutions, and then we're going to have some time at the end for questions and answers. All right, let's get going. Justin, let's start with you. To set the stage, what are the current market conditions for workers' comp?
So, as you probably know, or maybe you don't know, workers' comp is in a historical soft market. So we're at 8 years. It's a little longer for some states, but nationwide, we're on an 8-year soft market, which is probably the only line that is a soft market right now. If you read any insurance news, everything is very hard. Reinsurance rates are up for almost everything except for workers' comp. So, you know, why are we still, in a soft market? And really it's because work comp is still profitable. It's highly desired by most carriers, and most carriers, are writing other lines of business and including work comp, requiring work comp because it is profitable and allows them to write other lines of business that maybe are not as profitable. Auto right now, auto is, a pretty tough market. So you're seeing a lot of that, and it's high capacity, work comp, almost unlimited capacity, really. We don't have the same restrictions that you might see on E&S markets. So you can just write a ton of it. And the claims environment has been very stable. So carriers are able to adequately price. There's not a lot of surprises when it comes to claims for work comp. The frequency has been basically flat over the last couple of years. Severity's up a tick, but not enough to warrant any big changes. Rates are dropping. They're dropping this year as the file rates are hitting, and they're expected to drop for at least another 2 years, because the work comp industry is a bit retroactive. It takes a while for us to get the data in to see what the rates need to do, unlike E&S markets, which can be a little more nimble and change rates immediately. In an admitted market like work comp, we have to file, and it takes a while for that to happen. So, the work comp industry is in a good spot. You're not seeing a lot of big changes, and we're not susceptible to cat losses. So I'll talk about COVID a little bit later, but hurricanes, things of that nature, they don't affect the work comp world. 9/11 was one of the few cat losses that happened, and it was pretty regionally separated. But as far as that's concerned, it's a great time for carriers to be in the work comp game. It's a good time for us, even though it's a little harder to write business. And hopefully by the end of this, we'll be able to give you some tools to write more work comp and get set up for when this soft market gets a little more I don't think it's ever going to be hard again, but when it becomes a little more stable, you'll be set up to make even more money. So that's about the current market conditions.
What kind of rate declines are you seeing year over year? And I know it varies by state, but on average?
Yeah, so Morgan's going to kind of get into this with the results next, but I mean, on average, it's about 7%. You can see there are some double-digit states. You're saying, Virginia's and Tennessee's and stuff like that have dropped by double digits multiple times, and then you see other states which, they'll take a 2 or 3%, and really it's because states all have different, work comp is they have to comply to the current state statutes, and everyone's a little different. So, one may be more lenient for claims, and charge less, and one may not be. So that's why you see kind of different rates in different states there.
Great. Sorry to take your thunder there, Morgan. You want to talk about the market results?
Yeah, absolutely. Like Justin said, it does take NCCI a while to collect all of these numbers. So the numbers that I'm going over are actually for the year end of 2021. We have a little bit of 2022, but we won't have everything else until a couple more months. But the net written premium for private carriers for 2021 was 38.2 billion, which was only up over 0.5% over 2020. However, in the first 2 quarters in 2022, there was a 10% increase just for those two quarters. So it looks like 2022 is going to be much higher. And like Justin kind of said, 2021 was the 4th lowest combined ratio, and that's for the 8th consecutive year. Like Justin said, this really has never happened before in the work comp space. So it's the reason why all these rates they're just continuing to drop. And like Justin said, it's like on average around 6.5%, 7%.
Right. Justin, do you want to talk about the COVID trends that you had mentioned?
I will briefly talk about COVID. I think everyone at this point is just tired about talking about COVID, but it's still there, still playing a little bit of a role. But like I said earlier, so to me, COVID is like the work comp cat event that never happened. So we didn't know what was going to happen. Usually flu illness isn't a work comp claim because you can never know where it comes from. You could have got it on the way to work, you could have got it from your family. But with these presumption laws that went into place, all of a sudden it says, hey, we're just going to presume you got it at work, you can file work comp. So at first they were predicting, tens of millions, $100 million in COVID claims, but it really never happened. Certain states, California was one of them where they had higher COVID claims than other states, and that's due to presumption laws, of course. But in general, it really wasn't that big of an event. And because everyone was staying home, the losses for COVID were basically just balanced out with no losses in a lot of other industries because the people weren't there to get those claims. So COVID, at this point, it's run its course in a way. It's dying down. The claims have drastically dropped. The only thing that's left is long COVID. We don't know what's going to happen there with long COVID. These symptoms that people are just having still to this day when they got it 2 years ago. And if they filed a claim, and maybe if they didn't, but they could prove it happened during the time of these presumption laws, and we don't know if there's going to be a tail on them, but that could be something that in a few years comes back to maybe bite the work comp industry. But only time will tell. But as far as COVID is concerned, for the most part, that's kind of a non-issue at this point. It's kind of business as usual.
Great. Let's see, Morgan, how about talking about the renewal retention? How's that going with the workers' comp market?
Yeah, as we mentioned, with the rates, going down, continuing to go down, and then being so low, insureds really are not shopping out the coverage like they would normally do every year. They're tending to stay with the carrier for a longer period of time. So it's much harder to write new business for agents. They have to go out more, more sales calls, more face to face. One thing that agents are trying to do is write a lot of new ventures. Might not be a experience. Kind of get the ball going that way, but it definitely means that agents have to work harder for the business.
It's kind of funny because I'm obviously a P&C girl, and everything you've just said is exactly opposite of what everybody else is experiencing in this world. The P&C market is largely volatile, especially in property and reinsurance places. Rates are continuing to increase due to the hard market, not the soft market like you guys are facing. We know the dynamics are beginning to shift. There's underlying exposures like sales and payroll that are finally starting to increase as the economy picks up. And it's exasperated by inflation. Capacity tends to be an issue, and it has been for quite some time. Carriers are more selective and more strategic. And I think as it is for you guys, communication is the key. But everybody's out there shopping it, unlike what you just said. So, we're facing a lot of the same risks we're seeing year after year, and you guys are having to fight to get it onto the straight, which is interesting. All right, how about we delve into one of my favorite things, which are the claims examples. Let's, Morgan, why don't we start with you? Do you have anything that has come up recently that might be of interest?
Yeah, absolutely. I mean, who doesn't love claims examples? So I'll give 3 claim examples that are kind of in the same class of business, which is a pizza restaurant. And then I'll give a claim example of a fraud case that was interesting and how the agent helped out with the insured to kind of solve it and figure out that it was fraud. So with pizza restaurants, one of the claims that we had, which was all 3 are, we had an employee, one of the lights went out above a table in the restaurant. So the employee got a chair that had wheels on it and tried to change a light bulb while she was standing on the chair. Obviously it slipped out from under her. She fell. I believe she dislocated her shoulder. I believe she might have also had to get stitches, but it was around a $400,000 loss, something that could have easily been avoided. So that one was kind of, obviously the employee's fault. Another one we had, a burglar basically came in and had a firearm and held up the place to try to get money. And the cops came actually very quickly. And whenever they arrived, he used the girl that was behind the cash register almost like your hostage, kind of like a human shield. And once everything was done, she was fine. The guy went to jail, obviously, but she had PTSD from the event and was going to therapy up to 3 times a week. So whenever I actually got this notification, we were only 8 months after the claim had happened, and it was already over $1 million for that employee. So obviously, and that was one that's going to keep going because she's going to continue to go to counseling for her issues. And then the third one, this was a brick oven pizza place, and they were cooking pizza, and everybody knows the big wooden paddle board that they have to cook the pizza. The employee was removing a pizza, and she fell and slipped and threw the pizza on another employee. And the employee actually had 2nd and 3rd degree burns on their arms, chest, everything. So there were multiple surgeries involved, and that claim was also over $1 million. And then the final one, this one's actually pretty funny. An employee came in on a Monday, and he was a new employee for this construction company. And I guess he was having a bad day, and he decided he wanted to go home early. And they were framing a new building, and he decided that he wanted to go home, and he took a nail gun and tried to shoot a nail through his hand. But anybody that's ever used a nail gun, sometimes they can double fire. Well, he had his hand up against the wall, and it actually double fired into his hand. So they took him to the hospital and everything. The insured notified the agent, and he just had a funny feeling about it because it was a new employee. So the agent actually went out to the location And come to find out, there was a business next door that had security cameras, and they were able to see this guy kind of, pump himself up before he did this. And you could see he did it directly on his hand. So they were able to get that video camera, that footage, send it to the carrier the same day. By the next day, they already knew that they were declining his claim. So not only did he get to go home early, but he also lost his job. So, yeah, there are always some pretty interesting claims out there as far as work comp.
Always. Justin, what does it mean for claims as a whole? And do you have any examples?
Yeah, thanks, Morgan. Those are interesting. It's always I'm not going to say funny. It's not funny, but to hear other claims, it's very interesting, of course. But like we were saying earlier, claims have been pretty flat for work comp. Frequency, is fairly flat. Severity is up a little bit. You can hear that from like Morgan's claims examples, too. We're seeing some of these larger claims, arise, but with less frequency, carriers are still able to control, their profit margins on that. And the work comp in general, just with new OSHA guidelines and just better safety by management, you're just seeing a lot less losses in general. A lot more automation in manufacturing has helped cut out a lot of people getting stuck in machines and things of that nature with and they have to do lockout, tagout procedures. There's a lot of these safety innovations in place that are keeping, the American workers a lot safer. So, we're always going to have claims. We're human. We're going to make mistakes, but, they're trending in a good direction. I will, kind of look at some of the, classes. So like roofing is always going to be a difficult class because obviously if you fall from a roof, that's going to be a big claim. But the rate is kind of adequate for it. So we can, it's a little easier for people to write roofers, whereas, home health, you may have a hard time placing a home health account because you'll see a lot of claims in home health. You'll see people lifting, pulling their back.
Oh. Give me 1 second here. All right, Morgan, I guess we can come back to that. You want to talk maybe a little bit about, oh, Justin, you back? We lost you for a minute.
I'm back.
Awesome.
Back. I thought you guys were frozen. I was frozen.
Oh, the joys.
Where did I leave off?
We were talking about home health care when we lost you.
Oh, perfect. So it wasn't that long. No, as I was talking about is rate versus exposure. We have a low rate class of business, but also has the potential for higher claims. Those are the risks that you're going to have a hard time placing. And my claim example is kind of, it's kind of trending right now, and that's work from home. So definitely had a work from home case where somebody was, they were off the clock, but they were carrying files upstairs to their home office. They fell, and actually the claim was approved because it was in the course of work. So depending on the state, they have different, there's different wording on what's covered and what's not covered when you're working from home, and really it's a lot of gray area. But the court in this state said, yeah, that was a course, they wouldn't have otherwise carried those documents upstairs because that was part of their job, even though they were off the clock. And it's like a $20,000 claim. But when that class of business is clerical, the telecommunicating class is clerical, it's 30 cents, something like that. For carriers, it's really tough to write those classes because you have one claim and that account's never going to be profitable. So, if you have a company and everyone's working from home and you're getting a lot of declinations, that's why it's the rate versus exposure. You still have a lot of carriers that will write those classes, but just, I just want to kind of point that out that, even classes that you may think, oh, they just work behind a desk. Well, it could be a lot harder to write than you think.
We want to move on to forward outlook. What do we expect to happen in the next couple of years with workers' comp? I know it's been a very long soft market, but how long will it continue? What does 2-5 years look for us?
Yeah. Morgan, you want to start?
Yeah, sorry. As Justin mentioned, we're projecting for the next 2 or 3 years for rates to continue to decline on that average 6 to 7%, obviously depending on the state. But there could also be a possible recession. We're not sure yet. But what we're asking agents to do is, always stay on top of the insured's payroll. So if there is a large change in payroll, you might want to make sure that you're endorsing midterm instead of the audit. So an insured doesn't, they could end up owing, or they could get a large, return premium. Just kind of staying on top of the payroll, making sure the policy is correct. So the insured's not, doesn't have any surprises at the end of the term.
Justin, anything to add to that?
Yeah, right now we're it's been floated around for a while, and inflation, and we're definitely seeing some inflation. What does that mean for workers' comp? It means it's kind of a good and bad thing. So inflation usually leads to higher payroll, and work comp is based off of payroll. So it's going to keep those premiums around where they were. Even though the rates are decreasing, see kind of balanced out with inflationary trends. And obviously, if we hit a recession, that is the opposite. So in 2005, Morgan and I have worked together for many years. We started 3 months apart, but in 2005 we were doing work comp, and it was a recession, and it was audit after audit after audit of return premiums. So like Morgan was saying, you always want to stay on top of, your endorsements, your audits. And if you see trends, talk to your clients, and they'll really appreciate that too, especially if it's something where they would have to owe extra money on the audit. They'll really appreciate not having to do that all at once. And then forward outlook, carriers, their appetites are changing. So in the last couple of years, you've seen carriers really expand what they're looking for as far as classes. A lot more classes are profitable when they weren't profitable in the past. But just keep an eye on that too, because if the work comp market becomes hard for any reason, you may see carriers starting to withdraw from certain classes or from the industry in general. And you want to stay on top of that to make sure that if you had a carrier and they said they're getting rid of all tree trimming, and you have a big book of tree trimmers, you don't want to wait until those renewals are getting, it's 10, 15 days out. So, talk to us, talk to whoever you work with, and just let them help you. If you see any certain trends, XYZ carriers getting out of this class, we're like, great, let's set up a plan to help all your clients move without much of a headache to them or to you. So, forward outlook is still going to be a soft market for a few years, but we don't know what's around the corner. We don't know if there's going to be a little recession or not. But it's really just staying on top of the current topics and making sure that your clients are aware of that too.
Great. I want to get into some tips for brokers, but let's pause here for a second. I've got a couple of questions that I want to throw your way that have come in through our chat. The first one, we have noticed companies cracking down on independent contractor payrolls. Could this be an indication of the market hardening up?
Can you repeat the first part of that?
We have noticed companies cracking down on independent contractor payrolls. Could this be an indication of the market hardening?
Well, I think that has a lot to do with, especially certain states. And it's if this question is from California, that's a huge thing right now because of a lot of laws that are being passed where independent contractors are now required to be looked at as employees, and comp carriers. So I'll kind of back up a little bit. Independent contractors who don't have their insurance, whoever hires them has to assume their work comp claim. So even though they're a contractor, if I hire you one day to do this job for me and you got hurt and you don't have work comp, technically they could file work comp against you. So that's where a lot of the carriers are coming from. They want to make sure they have that premium because they were liable for those exposures during that time of work. And yes, I have seen a lot more carriers kind of be more strict as far as that's concerned. I don't think that's a case of the market hardening. I think it's more just due diligence on their part.
How about we've got a question about target markets and if we'd be providing a list. I know we're going to talk about specialty solutions, but do you want to touch on maybe some of the best risks for the agents to go after at this point?
Yeah, Morgan, you want to say some of your top ones?
Yeah, I would say, like I mentioned earlier, new ventures, since renewal retention is so high, a lot of agents are going after new ventures. We write a lot of higher risk, like Justin mentioned, tree trimming, roofing. Those are all, higher rates, so the premiums are going to be higher. And there's not actually a lot of markets out there that are not through the assigned risk pool that are going to write those. So lucky enough, we do have options for those types of accounts. And then also, your everyday like restaurant, road and mill type business, we have plenty of markets for. So really, there's not too many things that we're going to decline right off the bat. So really push for whatever you can get.
Great. Let me throw one more out your way and then we can move on. Do we have a market for non-renewed business?
Yes, it really just depends on the reason for non-renewal. So that's it kind of perfectly leads into the next section for the tips for brokers. It's giving us the full story. If we get an app and loss runs, and we can check through verification databases and whatnot to see what's happening, and it will tell us if there's a non-renewal in a lot of cases. If we have to find that out on our own, that's a different story than if you come to us and you're like, hey, this is being non-renewed, it's because of XYZ. We're like, great, let's go to the carriers that specialize in this type of business and they don't care about a non-renewal, so we can get there faster and get something back to you quicker, because usually a non-renewal will hit you and you'll not have a lot of time to market it, especially by the time it maybe gets to a wholesaler. So just let us know the reason for the non-renewal. I mean, in general, yes, we can write non-renewals. We love non-renewals because of what we do as wholesalers in the work comp business. We love that. We love that weird stuff. We love that hard to place stuff. That's why we're here, to support you.
Great. I know we've touched on a couple, but do we have any other tips that we want to provide the brokers at this point?
Yeah, I would definitely. One thing that we'll get a lot of submissions, and the federal ID number will be missing off of the Accord. That is extremely important when it comes to work comp, because that is the number that carriers use to reserve the market. So if we are blocked, that's how they use that number. So we'll know ahead of time not to approach this market because the federal ID number is already reserved. And like Justin mentioned, about the non-renewals, another big one is if there's a lapse in coverage, we're able to find out ourselves. And if we're not able to, the carrier's going to find out. So it's extremely important to just relay that to us that, hey, there's been a lapse. That way, it kind of limits the back and forth, and we know which can quote with the lapse, so we're not wasting the agent's time or our time approaching other markets that will not look at an account that has a lapse. So just be as transparent as possible. That way, we can get the quotes out quicker to agents.
Yeah, great points. For me, especially in this market of high renewal retention, it's finding out what the client needs. Because it may be, yes, they have a lower renewal quote, but they really just do not like this carrier's audits, that they don't like their billing system or something like that. Now is the time to find out what they need and use that as leverage to get their workers' comp, because the general saying is work comp is the foot into the door for the whole package. Right? You guys are out there, you want the property, you want the casualty, you want the whole line of business because that's where the money is, right? But the work comp is the way into it. And if you can find out, what a client needs, and not just, here's, the lowest premium, but hey, here's a great quote and here's why, let us know that, and we'll give you that carrier that offers, excellent claim services, or, they offer, supreme audit services, or, they do everything, or all of the above, or, maybe it is they don't want any of that. They just want the cheapest premium. So we can provide all that, but knowing what your client needs, that's going to be huge in winning that account.
We've got a really good question. I think that'll help out here. Is there anything members of other teams, like personal lines producers or individuals working the phone, what can they be doing or saying to help drive business for workers' comp?
Yeah, that's great. I'll touch on it a little and let Morgan touch on it. Really, it's just letting our partners, our agents, our brokers that work with us. It's not just work comp. It's every line of business at Burns and Wilcox. Letting them know that we have a solution. Like, oh, you wanted a GL quote on this, or you have a property, a personalized property, but he owns a commercial business. Say, oh, well, what about their other lines of business? Where are you going for that? And they may say, we're going to, XYZ wholesaler. Like, oh, we didn't know you did those lines of businesses. So it's really just, talking, and not just kind of staying within your own line of business. I'm guilty of it too. But if we get a work comp submission and it's not coming from another office, we could also say, hey, where are you going for your property and casualty? Because we have an office right down the road for you that's more than capable of helping you. So just, just getting the word out there, really.
All right, we had one request for your email addresses so they could send you some submissions, but anybody that needs that, we'll make sure we get that out after this presentation. Let's jump into specialty solutions. So there's a lot of things that have come up lately, like cannabis and some other hot topics. Whoever wants to take this one, let's talk about some of these hot markets and what we can do.
Yeah, Morgan, you want to start off, and then I'll kind of wrap it up.
Yeah, like you mentioned, the cannabis that is starting to boom everywhere, and we do have a market that is all that they are looking for, and it's just all they need extra is a quick supplemental application. We're able to get quotes on that, when before really there were not really many carriers out there at all that would even look at that class. But now they're starting to open up, be more open-minded about it. We do have a broader appetite, as I kind of mentioned earlier. We're able to do the tree trimming, the roofing, trucking. Home health care is one that is a little harder to write. Our carriers really like the skilled nursing, as opposed to somebody that is just going in and making sure they're fed, or cleaning up around the house. They want nurses that are actually administering medicine to the patient, which is what they call skilled nursing. That's kind of what they're looking for. But we do have markets that will take a look at the non-skilled nursing. They really like prior coverage to be in place before they take a look. And then besides that, like I said earlier, your everyday run-of-the-mill business, restaurant, what do they call Main Street America, we're able to quote those. And another thing about those is we're able to pretty much quote those same day. If they have prior or no prior, our carriers will give us pretty much an instant quote. So that's the turnaround time for those are very, very fast.
That's a great point to bring up. We hadn't talked about that yet, turnaround time. And I know there's some that you can get back same day. What about some of the other stuff? What can the agents, expect and anticipate?
Yeah, so something like roofing or tree trimming, if it's a larger account, one of our carriers, actually we have two carriers that would want to do a pre-quote inspection of the risk, which is why we ask that we get those submissions with fully prior updated loss runs, because that's what's needed to reserve the market for those higher, like I said, roofing, tree trimming, the higher rated risks. But they would want to do a pre-quote inspection. So we ask for at least around 30 days to quote those. But like I said, for restaurants, everything else, it's going to be either same day, maybe the underwriter's out of the office or something and it gets pushed to another underwriter, and it could be 2 to 3 business days. But the turnaround time, it really depends on the class of business and which carrier we have to approach.
Great. Any other solutions, Justin, that you think need touched on?
Yeah, that's all great points there. And, I like to say we write everything except for staffing or if it's exploding. If it's not one of those two things, send it in. We may just have a market for you. So, we want to see a lot of stuff from you because we're comp. You could have a class that gets declined 9 times out of 10, but it's that 10th one that, was the perfect fit for the perfect carrier. So that kind of leads into, we have over 12 carriers, maybe more than that in certain states, but it's really that we have a strong relationship with all of our carriers. We don't just have carriers to have carriers. We have carrier partners, and that's what we love. So, if we need to get something done quickly, or there's a situation that needs to be dealt with, or just anything like that, we can pick up the phone, we can talk to our carriers, and we can try to help as good as possible. That's really Burns and Wilcox, in every line of business, right? We focus on that we have the experts in it, and we also partner with the experts. And I think that's what's really nice and great about, working with Morgan. We've worked together for a while, and working with our partners. So Morgan and I, we pre-underwrite everything, and we get it out to the carriers that are going to fit it the best. We don't just blindly get your submission and forward it to 12 carriers and move on. That's not what we do. We look at every single account the day it comes in and get it to market that day for the markets that are going to quote it the best. So that's what you can expect from us. And hopefully we give you the best service.
And I wanted to piggyback off what Justin mentioned as far as staffing and if it explodes. Two other ones would be an owner-only policy or a ghost policy. We are not able to write those, or a paper contractor where it's just a supervisor and then they're subbing out all the work. We do not have markets for those. We get those questions all week, every week.
Good point. I do have one question that I think I know the answer to because this was not on your no list, but let's throw it out there anyway. You mentioned that you would entertain roofing with no prior. What about framing with no prior?
So roofing, actually, we have to have prior for roofing at least 1 year. Framing, it depends on the state. We in the Southeast, Justin, I believe builders will look at framing without prior.
Certain carriers may. I will say it's almost like roofing. Like most of them are gonna want that 1 year because those are the higher. That first year coverage is when a lot of the claims happen for young companies who don't have those safety procedures in place. That's why new ventures are kind of hard. But yes, we do have carriers. Framing for no prior is easier than roofing, which is almost impossible.
I have one final question here, and it just says claims. So I'm going to interpret that as what is our appetite? What are we looking for? Maybe you can just elaborate on claims for me.
Sure, I'll start. And so if you're asking if we can write accounts with claims, yes, we actually love accounts with claims. So the more claims on the current term, the harder it's going to be. If this claim is 2 to 3 years old, especially if it's a shock losses, we have carriers that they basically don't mean anything because it's a shock loss. They understand that it's going to happen. Frequency is really the killer for most carriers. If a client can't get their losses under control and there's just a ton of frequency, that's going to be tough. But we do have markets, and we have markets that specialize in rehabbing accounts. Now, those accounts typically have to be bigger, but they will go in there and they'll help them. They'll get those claims under control. They'll put in safety measures and help your clients. So not only can we write clean accounts and give you max credit, we can also write accounts with a lot of losses. And Morgan, I'm sure you have some insight there too.
You mentioned, a shock loss, and, our carriers, some of our carriers really like that because the mod is going to be extremely high, and, it's not a frequency issue. So it's kind of just a one-off claim, and the carrier is actually going to benefit by the high experience mod, which is why they like it. And then some carriers, whenever they see that frequency, they kind of back off a little more because the insured has a tendency to file or have a lot of claims and file claims. But when it's really just that one-off and the mod is extremely high, our carriers tend to like it. And we do have carriers that do not have a mod cap. They will look at any experience mod, which is very important.
Right. So I know we kind of mentioned this at the beginning, but let's drive this home. Do you think, Justin, I'm going to throw this one at you. Do you think there'll ever be a hard market?
I don't. I wish there would be. It'd be great. I'm seeing all my coworkers, writing, 25% renewal rates, and I'm a little jealous. But this is good for the economy, though. These entities out there, these businesses, they're paying lower so they can use this money in other ways. It's a good thing, safer, less people are getting hurt. Of course, we love that. So I don't think we're going to see a hard market ever again. I think eventually it will reach the point when loss reserves and carriers are going to get a little more picky, and they're going to kind of flatten out rates. But as far as a hard market, I don't see it happening unless there's some sort of COVID-ish, scenario that happens again that really affects our market.
Morgan, if I were a newer producer, can you tell me what access experience mods?
Yes, so if it's an NCCI state, the insured can actually get their experience mod from NCCI for free. And their current carrier can also access it for free. They would charge the retail agent or us, I believe it's what, Justin, $25, $27.
Yeah, it's almost $30 now.
Yeah, and all of their information is on their website, ncci.com. But we always say that the insured calling NCCI is the quickest way if their current carrier, or their agent is taking a while to get it from the current carrier. We always say the easiest way is for the insured to call NCCI directly.
Thank you. And Justin, I'm going to throw one more at you before we wrap it up here. And can you explain why there is no E&S market for workers' compensation?
Yeah, and it's pretty simple answer. So work comp is regulated by state statutes and laws, and by default, it becomes an admitted market. Unlike E&S, which can choose not to follow those, and they file that way. Work comp just by default becomes an admitted market, which makes it not as nimble as your other markets, as we talked about before. So work comp is very black and white. And carriers have their box, and it either fits or it doesn't fit. So especially if you're a big E&S agent or broker, and you kind of start getting into work comp, or you kind of have a one-off, and it's a little frustrating. That's why. It's just our industry doesn't have as many avenues to move through. We can't just be like, oh, $20,000 minimum premium, and they're like, sure, do it. I'm like, no, like for work comp, it actually has to be $20,000 or it's declined. We can't just push a premium on, like some other lines of business. So that's our admitted world over here.
Justin, do you have any parting words of wisdom for our audience today?
No, I hope we helped shed a little light on the work comp industry, and maybe gave you some tips. Just get out there and knock on some doors, call some people, and ask them what they're doing with their work comp, because they probably aren't even thinking about it. It's probably one of those bills they get in the mail, and they just renewed it because, hey, it's a little cheaper than last year. Why even look at it or shop it? Not knowing that there's probably other markets out there that can be even better or cheaper. Kind of like personal auto or something like that. You kind of get the renewal and you just let it renew. So go out there and get that, because like I said earlier, work comp is the foot in the door to the whole account. And if we can help you get that piece, you're going to have even more success growing by adding those other lines once you have that comp market, or adding the comp on after to make sure you don't lose the whole package account too.
Great, thank you very much. Morgan, I'm sorry, did you have anything you wanted to add?
I think Justin hit the nail on the head there.
Perfect. Well, as I mentioned, thank you all for coming and attending our webinar. If we've missed any questions, Justin and Morgan will definitely address them after the call. Just kind of as a recap, we are 8 years into a soft workers' comp market. We know it's tough, but just remember that there's over $40 billion of premium out there, and you've got to remarket your risks, or they'll decline. Use our expertise and our creativity, and feel free to give these gentlemen a call. So I hope you all have a wonderful rest of the day. Thank you very much.
Thanks, guys.